Hey, Keith here for Am I Rich, and today we're going to talk about a potentially great dividend stock. Yes, we're talking Cineplex. So, for those of you who don't know what Cineplex is a huge movie theater company. They dominate the movie theater industry in Canada. Now, you might be thinking, ooh, movie theaters, this could be risky. And you're right, this could be. But I think we might have a potential bargain on our hands. That's why I thought I'd talk about Cineplex today. So it's under the ticker symbol CGX. It's traded on the Toronto Stock Exchange. And currently its stock price is $24.74 Canadian. That gives it a PE ratio of 20.3. It has a forward PE ratio that is estimated at 19.5. And it also has a price to book value at 2.3. Now, the big thing about this stock is its dividend. It's currently sitting at 7%. And that is an amazing dividend. So if you can hang on to 7%, and it's not just 7%, but it's 7% that's growing. So, or potentially growing. So that really is part of the big story here. And now if you look at its 5-year growth rate, it is something to question. It is annual growth rate of minus 1.6%. They did have some growth last year, so that's kind of bucking the 5-year trend, but even the last 2 years they had negative growth as far as their intrinsic value goes. So what's the story with Cineplex? So Cineplex, yes, it is the dominant movie theater company, and they still do well on big blockbuster movies that are like superhero movies, Star Wars, or like some of the repeat franchise movies. But they don't do that well on other movies that come out, and they are aware of this, so they have been trying to transition their business for a while. And so a lot of their business that they're moving into, they have places like the Rec Room, which are like recreational or entertainment areas that people go to. These are quite popular in Canada and around where they have their facilities. They're kind of competing with other big gaming kind of, franchises out there. So I still see those kind of industries as being something that people want to do. So I still think even in the future, if movie theaters, maybe people still want to see movies but only want to see the big ones, and then the smaller movies they just want to see at home on Netflix or some other future, Disney Plus or Prime or whatever is coming out. So that is still a segment that people will want to go to. They'll still want to go to these. They still want to do something with their friends or family, so they're still going to want to go out for a game night or a whatever. So whether you want to go shoot up some stormtroopers or just do something, some kind of activity like a escape room or something like that, they have these kind of rec rooms, and you can play pool or whatever, and then you can have food as well. So these facilities do seem to be still doing well. They have really good cash flow. They're upgrading. They have a lot of their theaters have upgraded to kind of VIP status kind of theaters, and those charge a huge premium. They already make a huge killing on their popcorn and drinks or whatever that they sell at the theater. So cash flow is not a huge issue. They do see a very maybe a stable market in the movie theater, maybe a potential decline. And so they are transitioning. So they're basically taking all that cash flow, and aside from becoming kind of a dividend stock, which they definitely are with 7% dividend, if they can maintain that, which it seems like at the moment they should be able to maintain that. So if they can maintain that, people will want to invest in it for that. And then also the plus side is they are using their extra money to try and do strategic purchases. They're trying to get into more of the gaming kind of world. I think they bought the World Gaming Network, or 80% of it or something, several years ago. They're trying to find ways to attract the youth crowd into some part of their platform that they've distributed. So whether those strategies are going to work or not. So that's the positive case. The negative case is these strategies don't work. Their business slowly dwindles down, and you just see them eventually not being as profitable. Now, to their success, they have been growing revenues. Whether they've been growing earnings that much or not is a different thing, but they have been growing revenues. So they've been transitioning. So it's possible, but the negative thesis or bear thesis on this company would definitely be they might be in a situation where they can't get more, they're stuck with their theaters, or people just don't want to go out anymore, which maybe, who knows if that's the trend, but if that's the case, they'll slowly see their sales dwindle, their margins probably will stay the same or maybe go up. They'll just try and revamp it as much as they can, and then eventually they'll have like these big theaters that they're renting that they're going to have to try and do something with that's more profitable. So that's kind of the negative part of it. The other thing is they have a lot of goodwill in there, if you look at their finances. And the problem with some of their goodwill or intangible assets even, it's like maybe intangible, they put a lot of money on their customer loyalty. So yes, people who do like to see movies keep going to movies. That's maybe true, but it's a little bit risky, because what if some people are tending to go less to movies, and what if these people suddenly aren't as loyal for whatever reason? Then you can see that as being an issue for the company. I don't know that the way people's behavior is, I don't think that that's going to be a fast transition, because people who really like their scene points or something like that, they're just going to keep using that. They might slowly taper off, or you'll have people slowly drop off, but it'll be a slow decline. And so basically I see this company, they might be able to rebrand themselves, reposition themselves. Otherwise they're going to probably see a slow decline in their business. If not, if they're lucky, maybe a stabilization. And they'll probably position themselves as a dividend stock, so you probably can keep a dividend for the next several years. If anything, they probably don't have a lot of huge financial headwinds against them. If they did make some big acquisitions that were really costly, then you could see major issues with this company, because then they wouldn't be able to afford it. Maybe in the future they'd have to write down lots of their goodwill, and then basically investors would be left with very little or nothing. And so that would be the huge risk. So the biggest risk is probably in a long-term scenario going to zero for their stock. But the good side scenario is 7% dividend. I think the stock is probably undervalued right now. I kind of see it as, if it was a nicely growing company, it would probably be worth $40, because it's not. Like $30 maybe is more reasonable, and it's sitting at $24.74 or something. So I still think it's kind of a bargain right now. But that stock price could drop because they might not realize their new vision of diversifying. And so because of all that, I think the main play on this company would be, can you get that 7% dividend long enough to basically pay for your investment and get out, or without losing too much, or like maybe they will. So the downside would be they could go to zero, but it could be long enough that you could get the 7% dividend to get your money back at least. And then the upside would be they do reorganize their company to a new structure that is still doing well, so they could have some mild growth in their stock, or they get some kind of gaming industry breakthrough that the next Twitch or something. I don't think that's going to happen, but if they did, you could see major upside that way. So they could have slight upside, I would think, from the stock more realistically, and again, a continuing great dividend. So that would be the positive side. For those reasons, I do think it's cheap. I definitely think if someone is looking for a dividend, this is a very interesting stock to look into. Me personally, I'm not really sure at the moment because yes, 7% dividend sounds great, but because of the headwinds with this company and the potential downside, I just haven't figured out in my mind how long this company has. I think the loyalty is there. Like, I thought movies would have been dead like early 2000s. So since they're not yet, then I kind of think this company has still a few more years in it to go. And so it is probably a really good dividend stock. I personally would say it's a hold though for me. Like I would hold on the position if I had it. So yeah, I'd love to know what you guys think. What do you think of Cineplex? Do you guys think this stock is due for a bounce? I think if it did bounce up in the next 3 to 6 months, I wouldn't be surprised at all because it is quite undervalued, I think, right now, and it has a great dividend. But that said, yeah, I mean, it's not really growing. It's kind of declining. So the forward PE ratio, people are estimating growth, but it's even that, 0.5 or 0.8 or something. It's not that dramatic. So yeah, let me know what you think in the comments. Otherwise, thanks for watching, and we'll talk to you in the next video.